What are repurchase agreements in shadow banking? Imagine a quick way for financial firms to get cash without going to a bank. That's what repurchase agreements, or repos, are all about. They are a common tool in the shadow banking system. A repo is like a short-term loan secured by assets. One party sells a security, often government bonds or other high-quality assets, to another party. They agree to buy back the same security later at a slightly higher price. The difference in price is how the lender earns interest. This setup makes it a secured loan, with the security acting as collateral. In shadow banking, these agreements are vital. Non-bank financial firms, called shadow banks, do not take deposits like regular banks. They cannot access central bank support or safety nets. Instead, they rely on market-based funding like repos. These agreements help shadow banks raise short-term cash to fund their activities. They often buy long-term or less liquid assets and turn them into short-term liabilities. This process allows them to lend money and provide liquidity to the financial system. Repos are especially useful because they let shadow banks quickly convert assets into cash. This helps them manage liquidity and fund risky or long-term investments. Historically, before the financial crisis of 2007 to 2009, the shadow banking system grew rapidly. Repos played a big role in expanding credit. They allowed shadow banks to issue large amounts of short-term debt backed by complex assets. This made the system efficient but also risky. If asset prices fell suddenly or confidence dropped, it could cause a quick rush to sell assets and withdraw funds. This could lead to liquidity shortages and financial instability. Looking back, repos in shadow banking show how financial innovation created a parallel credit system outside traditional banks. This system increased access to credit and liquidity but also made the financial system more fragile. Because repos depend on the value of collateral, any sudden change in market conditions can cause problems. During times of stress, the chain of transactions can amplify risks, leading to potential crises. In practical terms, repos help non-bank financial firms get short-term funding without relying on deposits. They transform longer-term assets into cash-like instruments and reduce counterparty risk through secured lending. Repos also enable credit to borrowers who might not qualify for traditional bank loans. Understanding how repos work in shadow banking shows how financial markets evolved to meet the demand for quick, flexible funding outside the regular banking system. It also highlights how these practices have shaped modern financial history and influenced regulations after the global financial crisis.